46 letters, 7 reversals. Warren Buffett told shareholders the exact opposite of what he actually did. One of those reversals cost him $4 billion, and he never named it. We did. We read every annual letter Buffett signed since 1977, 46 of them, cross-checked against Munger, Howard Marks, and decades of filings. 7 times the letter said one thing, the portfolio did another. Here they are, in order of damage. For decades, Buffett had one rule about technology: don't touch it, stay inside the circle of competence. Tech companies were not something Berkshire could evaluate with confidence. 2000 dot-com bubble. Berkshire badly trails the S&P as the rest of the market rides tech. Shareholders are furious. Buffett does not flinch. Tech is outside the circle, not touching it. 16 years pass. The rule holds. Then in 2016, something unusual shows up in Berkshire's 13F filing. A major position in Apple, initiated by one of Buffett's portfolio managers. A tech company Buffett had refused for decades. Buffett personally expanded the position aggressively across the following years. By the 2017 annual letter, Berkshire disclosed 166 million shares of Apple, valued at $28.2 billion. It was already one of Berkshire's top holdings. Buffett's public framing, repeated in interviews and annual meetings, became the justification. Apple, he argued, was not really a tech company. It was a consumer products company. Read that framing twice. The rule against tech didn't change. The definition of tech did. Apple, a company whose value rested on iPhone hardware, chip architecture, and software ecosystems, became a consumer products company. Reversal 1. The Apple rule. This is the first reversal. Not a change in principle. A redefinition of terms so the principle could bend without breaking. By 2023, that Apple position would grow beyond $150 billion. One of the most profitable equity positions in Berkshire's history, built in direct tension with a rule Buffett had publicly held for decades. 7 reversals, 6 to go. The next one cost him billions. 1989. Berkshire buys U.S. Air preferred stock. It is Buffett's first major airline bet. Within weeks of the ink drying on the check, the company goes into a tailspin and stops paying the preferred dividend. Berkshire got lucky. In a burst of optimism for airlines in 1998, the position was sold for a hefty gain. The company went bankrupt. Twice. Nearly 2 decades later, in the 2007 annual letter, Buffett writes the warning that becomes legend. Think airlines. A durable competitive advantage has proven elusive ever since the days of the Wright brothers. If a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. Investors have poured money into a bottomless pit, attracted by growth when they should have been repelled by it. That warning stood as settled doctrine. For 9 years, Berkshire owned 0 airline stocks. Then 2016 arrives. Berkshire's 13F shows something impossible. 4 airline positions: American, Delta, Southwest, United, all 4 major U.S. carriers, simultaneously. Over 3 years, Berkshire accumulated nearly $8 billion in airline stock. By the 2019 annual letter, Delta Air Lines appeared as one of Berkshire's top 10 equity holdings. The warning from 2007 had quietly reversed. March 2020, COVID. In a matter of weeks, global air travel collapsed 96%. Airline stocks crashed 60 to 70%. At the virtual Berkshire annual meeting on May 2, 2020, Buffett announced the exit. All 4 airline positions sold. At the bottom of the crash. The reason, he said, was that the world had changed for airlines in a way he had not anticipated. The exit wiped out roughly $4 billion in shareholder capital. Round trip from fatal attraction to conviction, back to fatal attraction. Here is what Buffett did not say. He did not name the dollar figure. He did not walk shareholders through the decision timeline. The 2020 annual letter, published early 2021, does not contain a narrative account of the airline exit at all. The 4 airlines that were a conviction bet 1 year earlier simply disappear from the letter. "I made a mistake" is not $4 billion. It is a sentence. The $4 billion is what shareholders actually paid for the round trip from fatal attraction to conviction, back to fatal attraction. Reversal 2. The airline round trip. This is reversal number 2. Not a change of heart, a complete round trip. The 2021 and 2022 letters never return to it. The $4 billion lesson has no chapter. The other 5 reversals are smaller. They are also in some ways more telling. That was reversal 2. Now to the reversal you can read in a single letter, because this one contains the warning and the practice on pages that face each other. Reversal 3, derivatives, 2008 annual letter, the financial crisis in motion. Buffett wrote the warning directly, quote, "Derivatives are dangerous. They have dramatically increased the leverage and risks in our financial system." The same letter, a few pages later, disclosed the number. 251 derivatives contracts on Berkshire's own books. Equity index puts, credit default obligations. In plain terms, high-stakes insurance bets on market indices and corporate bond defaults, held by the same company whose CEO had just labeled derivatives dangerous. Not a past position, not a recent adjustment, active book. 251 contracts, disclosed as current state, same letter, same signature. The warning was public. The practice was internal, both in one annual letter. 3 more reversals follow the same structure. Reversal 4, IBM. The 2011 annual letter disclosed a $10.9 billion position praised for its long-term share repurchase program. By 2018, Berkshire had exited. The later letters barely mentioned the reversal. Reversal 5, gold. The 2011 letter rejected it on record, quote, "Neither of much use nor procreative." 9 years later, second quarter 2020, Berkshire's 13F showed a new position in Barrick Gold. Fourth quarter 2020, the position was gone, never mentioned in the annual letter. Reversal 6, buybacks. For decades, Berkshire issued shares more often than it repurchased them. The 2018 annual letter announced the shift, quote, "Berkshire will be a significant repurchaser of its shares." Then one of the largest corporate buyback programs in the U.S. 3 reversals, 3 silences. The pattern doesn't need long stories. Public position, internal reversal, quiet exit. Reversal 7, market timing. The most repeated principle Buffett ever wrote. You cannot time the market, stay invested. Be fearful when others are greedy, but do not predict turning points. Then the 2024 letter addressed the cash position directly. Quote, "Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities." The same letter disclosed the move. Marketable equities had dropped from $354 billion to $272 billion in a single year, an $82 billion reduction. Not timing the market is one thing. Selling $82 billion of equities in a calendar year is something else. That was reversal 7. Charlie Munger, Buffett's partner of 60 years, handled these contradictions differently. Across decades of interviews and annual meetings, Munger was consistently more direct about errors. He was willing to enumerate specific mistakes by company and by year in terms that did not allow for rhetorical softening. Buffett's annual letters rarely do this. The letters are written in a specific style, part teacher, part folksy uncle, part historical narrator. Mistakes appear as abstractions. We were wrong. The thesis changed. The world evolved. This is not dishonesty. It is a rhetorical choice. The annual letter is not a confession booth. It is a communication document aimed at holding shareholders through multi-decade compounding. Howard Marks, the legendary Oaktree value investor and peer of Buffett, has written extensively about how investors treat errors. In a 2003 memo laying out Oaktree's operating principles, Marks stated the rule directly. Quote, "Admit when things go wrong without hiding behind excuses." That sentence describes a posture. The annual letter as a format does not always honor it. Not because Buffett is dishonest, but because the genre itself rewards continuity over rupture. Every reversal we just counted shares a structure. Buffett takes a public position. The world changes. Buffett changes. The annual letter does not fully revisit the original position. The new position becomes the new orthodoxy. The question is not whether this is dishonest. The question is what it costs to do the opposite. Investors who kept exiting tech because Buffett said he wouldn't touch it missed the greatest equity bull market in history. Investors who took his airline warnings from 1989 as gospel in 2016 would have been right twice. Most people would still be wrong on net. 7 reversals across 46 letters. Apple, airlines, IBM, gold, derivatives, buybacks, market timing. Each one, the written record said one thing and the portfolio did another. The $4 billion airline loss is not the lesson. The lesson is the structure of the letters themselves. A great investor writes his principles in permanent ink. He reserves the right to revise them in pencil, quietly, without returning to the original page. This is not a flaw. This is the operating system of a 60-year compounder. The investors who copied only the letters lost. The investors who understood the structure won. I turned the pattern into a practical worksheet. 6 signals to audit any open position, a framework to separate your permanent convictions from your revisable hypotheses, and a 15-point structured exit checklist. Not a summary, a tool you fill in. Link in the description. More breakdowns like this one on the channel. Subscribe to catch them all.